Capital rarely announces itself when it enters a room. It observes first. The firm operated from the upper floors of a glass structure overlooking a city that valued velocity. Screens lined the walls. Data flowed continuously. Decisions were framed as urgency. Authority was measured by visible motion. Who spoke fastest, who reacted first, who appeared decisive under pressure. Noise created hierarchy. At the center of the firm sat the managing authority, not theatrical, not impulsive, but visibly dominant. The posture was forward-leaning, speech concise, interruptions frequent enough to signal control without appearing erratic. Others adjusted cadence in response. Reports were tailored not only to content but to temperament. Anticipation structured the environment. Investment committees convened weekly. Proposals competed for allocation. Analysts refined projections repeatedly before presentation, attempting to predict which variables would resonate with the managing authority's instincts. Approval was less about numbers and more about alignment with preference. Preference, over time, becomes policy. The imbalance had formed gradually. Early success validated centralized intuition. A sequence of profitable exits reinforced the belief that strategic insight resided singularly at the top. Results became mythology. Mythology became leverage. Leverage concentrated in one voice. Within this environment, one participant remained unusually quiet, not disengaged, not hesitant, present, yet unassertive. Contributions were sparse, timed with precision. When asked for input, responses were direct and stripped of embellishment. No attempt to impress. No attempt to dominate discussion. Silence, when voluntary, unsettles accelerated systems. The silent participant held capital independent of the firm. Not majority control. Not enough to dictate openly, but sufficient to influence long-term direction if exercised deliberately. That capital remained inactive at first. Observation preceded movement. Meetings revealed predictable patterns. When a proposal aligned with the managing authority's prior successes, it advanced quickly. When it deviated, scrutiny intensified beyond proportional necessity. Risk assessments were reframed to highlight weaknesses rather than balance them. Risk became subjective. The silent participant noted something more subtle. Emotional energy directed toward maintaining central narrative. Analysts defended projections less to protect capital and more to secure approval. Language shifted depending on who had spoken last. Fluidity of tone indicates dependence. The imbalance was not abusive. It was efficient. The firm generated returns. Investors remained satisfied. Performance metrics justified hierarchy. But efficiency concealed fragility. When authority depends on continuous affirmation, it requires constant reinforcement. Reinforcement demands reaction. Reaction accelerates noise. The silent participant rarely reacted. When allocations were discussed, no visible urgency surfaced. When decisions were delayed, no frustration appeared. The posture remained composed, as if time operated differently. Time is leverage in environments driven by immediacy. Weeks turned into quarters. Market volatility increased. External conditions introduced uncertainty. The managing authority intensified control over decision-making. Fewer proposals advanced without direct endorsement. Informal conversations before meetings became more strategic. Individuals attempting to secure preliminary approval before public discussion. Pre-approval creates informal power corridors. The silent participant avoided those corridors. Instead, analysis was shared transparently across departments. No private persuasion. No alliance building. Data was distributed openly, allowing others to evaluate independently. Transparency redistributes influence. The managing authority interpreted this behavior initially as disengagement. The absence of lobbying suggested lack of ambition. The silent participant did not correct this perception. Underestimation reduces scrutiny. As volatility persisted, the firm encountered its first significant miscalculation in years. An investment previously championed by centralized conviction underperformed sharply. Publicly, the decision was defended as long-term positioning. Internally, unease surfaced. Unease shifts orientation. During review sessions, the managing authority spoke with measured firmness, emphasizing macro conditions and unforeseeable disruptions. Others nodded. Some offered supportive commentary. The silent participant offered none. When asked for assessment, the response was brief. Structural exposure had exceeded tolerance thresholds. No accusation, no elaboration, just factual framing. Facts, when neutral, are difficult to confront. The imbalance deepened temporarily as the managing authority reasserted presence. Oversight increased. Smaller allocations required direct review. Analysts were instructed to present scenarios with greater emphasis on downside mitigation. Control tightened. The silent participant complied without visible resistance. Reports submitted were increasingly rigorous, stress-tested under extreme conditions, diversified across correlated risk vectors. They required minimal reinterpretation. Minimal reinterpretation reduces interpretive authority. Gradually, a subtle distinction emerged. Proposals associated with centralized conviction continued to rely on narrative confidence. Proposals associated with the silent participant relied on structural resilience. Resilience outlasts conviction in volatile climates. The firm's performance stabilized unevenly. Gains emerged from diversified positions structured quietly through disciplined allocation. Losses continued from legacy investments tied to earlier concentrated strategies. No direct correlation was acknowledged publicly, but internally, patterns were visible. The imbalance now rested on perception rather than outcomes. Authority remained centered, yet returns increasingly reflected distributed methodology. The silent participant did not highlight this shift. Highlighting invites confrontation. Instead, capital was reallocated incrementally. Not dramatically. Percentage points moved between sectors under the justification of portfolio optimization. Over time, exposure patterns adjusted. Gradual repositioning avoids alarm. Other partners observed these shifts. Some began mirroring the diversified approach discreetly, not as defiance, but as prudence. Language within meetings began incorporating structural terminology previously absent: volatility corridors, asymmetric hedging, layered liquidity buffers. Vocabulary signals orientation. The managing authority maintained visible control, yet discussion no longer revolved solely around instinctive positioning. It began referencing structural alignment. Decisions still required approval, but approval increasingly ratified frameworks already matured through distributed analysis. Ratification differs from direction. The silent participant's capital remained patient. No demand for greater voice. No assertion of entitlement. Patience, when supported by independent resources, creates quiet leverage. The imbalance was still present. Titles unchanged. Voting rights unchanged. The managing authority still convened meetings, set agendas, controlled final signatures. But beneath that surface, dependence shifted subtly. Other partners began consulting the silent participant informally, not for permission, but for calibration. Conversations remained private, analytical, restrained. No coalition formed. No alliance declared. Influence began diffusing through competence. The silent participant continued investing without spectacle. Capital entered positions others overlooked, less glamorous, structurally sound, designed for endurance rather than acclaim. Endurance does not generate headlines. It generates continuity. The managing authority sensed gradual distance. Meetings felt less reactive. Fewer participants sought emotional endorsement. Presentations arrived less tailored to personality and more anchored in framework. Framework decentralizes charisma. The silent participant never challenged authority publicly. Challenge would have clarified opposition. Instead, capital flowed according to internal metrics. Those metrics increasingly shaped overall portfolio behavior through silent gravity. Gravity operates without noise. By the end of the fiscal year, performance reports revealed a subtle but undeniable pattern. Stability correlated with distributed, disciplined allocation. Volatility correlated with centralized conviction. The managing authority acknowledged the numbers. No public shift occurred, but the foundation had moved. The silent participant had not expanded presence, yet influence had grown. The imbalance, once reinforced by narrative confidence, now rested on habit rather than necessity. Habits can be recalibrated, and recalibration rarely announces itself. The firm continued operating under the same hierarchy, but the center was beginning to feel lighter. The shift did not accelerate. It narrowed. Volatility in external markets persisted, but inside the firm the pressure became internalized. Performance reviews grew more granular. Capital allocation meetings extended in duration yet reduced in emotional temperature. Data sets expanded. Models thickened. Language tightened. Compression does not appear aggressive. It appears disciplined. The managing authority retained visible command of the table. Agendas were still set from the head position. Questions were directed sharply. Interruptions occurred when projections drifted toward speculation. Yet something subtle had changed. Speculation now arrived already constrained. Analysts began structuring proposals through layered probability frameworks before presenting them. Sensitivity analyses were embedded directly into executive summaries. Downside exposure was quantified with precision rather than softened through optimism. Optimism had lost its dominance. The silent participant contributed rarely, but each contribution recalibrated direction. Not by contradiction, by addition. A single question about liquidity depth could shift emphasis. A brief observation about correlation risk could redirect allocation weight. No debate followed. The room adjusted. Adjustment without resistance signals influence. The managing authority increased scrutiny over distributed positions. Requests for deeper modeling intensified. Certain allocations were temporarily paused pending further evaluation. The language remained composed, yet the frequency of review indicated tightening oversight. Oversight under compression tests durability. The silent participant responded by expanding structural transparency. Portfolio dashboards were redesigned to display real-time exposure mapping across sectors and time horizons. Risk layers were color-coded, stress thresholds clearly defined. Nothing hidden, nothing exaggerated. Transparency absorbed pressure. Other partners began referencing these dashboards during meetings, not as endorsement, but as reference architecture. The firm's internal orientation slowly shifted from narrative positioning towards systemic visibility. Visibility reduces interpretive monopoly. The managing authority maintained composure. Performance metrics still reflected centralized successes from prior years. Institutional memory remained aligned with earlier conviction-driven gains. But memory cannot override current structure indefinitely. A second miscalculation surfaced, smaller than the first, yet symbolically disruptive. A concentrated position, defended strongly months earlier, underperformed again under market strain. Losses were manageable but visible. Silence followed the report. No one reacted dramatically. The silent participant did not speak. The numbers remained on the screen longer than usual. Extended silence alters weight distribution. When discussion resumed, it was procedural. Containment strategies, rebalancing schedules, liquidity sequencing. The managing authority spoke with measured calm, framing the event within broader strategic context. No challenge emerged, yet no affirmation followed either. Affirmation had once been immediate. Now it was neutral. The silent participant adjusted capital exposure quietly in subsequent days, incrementally reducing correlated positions while increasing allocations to structurally insulated sectors. The adjustments were proportionate, rational, devoid of commentary. Capital moves signal confidence more effectively than speech. Gradually, other partners mirrored these reallocations. Not overtly, simply through rational convergence. Distributed prudence began shaping aggregate portfolio posture. Aggregate posture defines identity. The firm's risk profile shifted without formal declaration. Volatility bands narrowed. Liquidity buffers expanded. Exposure ceilings tightened. Centralized conviction lost oxygen. The managing authority attempted subtle reassertion through thematic positioning. A new sector narrative was introduced, framed as transformative, high upside, strategically aligned with macro transitions. It carried the tone of renewed directional clarity. Several partners expressed interest. The silent participant requested extended due diligence windows. Not objection, just time. Additional scenario modeling, regulatory mapping, supply chain stress tests. Time-cooled momentum. Momentum thrives on enthusiasm. Weeks passed. The thematic position advanced in moderated form, scaled smaller than originally proposed. Safeguards embedded. Exposure limited. The shift was procedural, but the symbolic center moved further. The managing authority's proposals were no longer advancing through gravitational pull alone. They required structural validation comparable to distributed strategies. Validation equalizes hierarchy. Internal communication reflected this recalibration. Emails from junior analysts referenced risk corridors rather than narrative alignment. Investment memos emphasized asymmetry and downside containment over bold upside narratives. Language shapes power. The silent participant remained externally unambitious. No requests for expanded voting rights. No proposal for structural change. Capital stayed patient, compounding quietly within diversified layers. Patience becomes strategic compression when others operate under urgency. External investors began noticing stability in quarterly reports. Returns were less dramatic than previous high-growth periods, but drawdowns had moderated significantly. Volatility dampened. Institutional clients value predictability over spectacle. Questions emerged subtly during board reviews. How had exposure discipline tightened so effectively? What processes had been adjusted? The managing authority attributed improvements to team refinement and enhanced modeling tools. Technically accurate, incomplete. The silent participant did not correct the narrative. Narratives lose relevance when outcomes speak consistently. The compression reached a structural threshold when a major reallocation required near-unanimous consent under firm governance rules. Historically, such proposals relied heavily on centralized endorsement. This time, distributed analysis preceded formal presentation. By the time the vote occurred, consensus had formed organically through data circulation rather than executive persuasion. The managing authority voted in favor. But the motion no longer depended on that vote. That distinction settled quietly in the room. No acknowledgement surfaced, yet the center had narrowed further. Influence now flowed through capital alignment rather than verbal dominance. The silent participants' disciplined allocations exerted gravitational effect without overt leadership. Gravitation requires mass, not noise. Other partners increasingly sought calibration before presenting proposals, not to secure approval, but to ensure structural coherence. Conversations remained technical, restrained, devoid of alliance-building rhetoric. Coherence replaced charisma. The managing authority maintained visible composure. Titles unchanged. Signature authority intact. Yet directional control now required structural conformity to distributed frameworks. Conformity redefines hierarchy. The silent participant never occupied the head of the table. Position remained unchanged physically. Influence expanded without relocation. This distinction marked compression's maturity. The firm's identity transitioned from conviction-driven performance to system-driven resilience. External perception improved accordingly. Ratings agencies cited disciplined risk management. Institutional confidence strengthened. The managing authority retained public credit. Internally, however, authority had shifted into architecture. Architecture does not yield easily once stabilized. Compression had reduced volatility not only in portfolio exposure, but in power distribution. Emotional gravity diminished. Decisions advanced through documented alignment rather than persuasive momentum. The silent participant remained composed. No expansion of visibility. No assertion of superiority. Only steady capital flow aligned with structural discipline. By the end of the fiscal cycle, the firm operated under a new equilibrium, still formally centralized, yet functionally distributed. The imbalance that once favored narrative conviction had narrowed into structural parity. The final phase would not involve further tightening. It would involve permanence. And permanence requires quiet inevitability. The final transition did not begin with a proposal. It began with absence. A major allocation cycle approached, one historically dominated by centralized vision. In previous years, this cycle had defined the firm's strategic identity. Direction was announced with controlled certainty. Capital followed. This time, no grand narrative surfaced. Instead, frameworks circulated weeks in advance. Risk envelopes were defined collaboratively. Exposure ceilings were pre-calibrated. Sector rotations were mapped according to liquidity architecture rather than thematic momentum. By the time the formal meeting convened, most decisions had already matured through distributed analysis. The managing authority opened the session with the same composed posture. The agenda remained structured. Tone steady. Questions precise. Yet the energy in the room had shifted from anticipation to review. Review does not grant dominance. It acknowledges structure. Each proposal advanced through layered validation. Scenario matrices accompanied every allocation. Downside stress thresholds were pre-agreed. Capital weights aligned with risk corridors defined collectively over prior quarters. The silent participant spoke sparingly. A clarification here. A liquidity reminder there. No persuasive tone. No directional assertion. Others adjusted accordingly. When the final summary appeared on screen, something subtle became evident. The aggregated portfolio posture reflected distributed calibration more than centralized conviction. The managing authority reviewed the numbers carefully. No objection. No reframing. Approval was granted without revision. The shift completed in that moment, not because authority conceded, but because it no longer needed to contest. Control had transformed into confirmation. After the meeting, no visible celebration occurred. The silent participant returned to regular workflow. Capital allocations executed through standard channels. Market exposure adjusted incrementally. No announcement declared new leadership. But internally, orientation had settled into permanence. In subsequent weeks, external volatility intensified unexpectedly. A geopolitical disruption rippled through correlated sectors. Several firms across the industry experienced sharp drawdowns. Within this firm, exposure absorbed impact within defined tolerances. Losses occurred, but containment held. The distributed architecture functioned precisely as modeled. Liquidity buffers activated. Hedged positions offset concentrated pressure. Capital rotated automatically according to predefined triggers. No emergency meeting was required. The managing authority issued a brief internal note acknowledging resilience and procedural strength. The tone was measured, devoid of self-attribution. Resilience had become systemic rather than personal. External investors noticed. Confidence strengthened. Institutional inflows increased modestly, drawn by stability during turbulence. Stability attracts capital more reliably than spectacle. Within the firm, conversations shifted permanently. Junior analysts referenced structural safeguards as default practice. Investment theses began with risk alignment rather than growth narratives. The culture recalibrated. The silent participant did not expand presence. Voting power remained unchanged. Title unchanged. Office unchanged. Influence, however, no longer required assertion. Influence had embedded itself into protocol. The managing authority adapted without visible friction. Public appearances maintained continuity of leadership. Interviews referenced collaborative excellence and disciplined governance. Technically accurate. The internal center of gravity had migrated. Migration is irreversible when anchored in habit. Weeks later, a symbolic moment occurred quietly. A new strategic initiative required rapid evaluation under compressed timelines. Historically, such urgency would have triggered centralized directive. This time, distributed risk committees activated immediately, drawing on established frameworks. Within 48 hours, consensus emerged through structured channels. By the time the managing authority convened the executive session, the recommendation was fully formed. Approval followed swiftly. No reinterpretation necessary. The room felt composed, efficient, self-regulating. Afterward, no one remarked on the speed. No one referenced the absence of friction. But the silent participant recognized the threshold. Authority had ceased to be the source of direction. It had become the steward of structure. Stewardship is stable. It is also limited. The firm's long-term strategy document was revised that quarter. Language emphasized sustainability, layered resilience, and distributed evaluation models. Narrative conviction received less emphasis. Emotional language disappeared almost entirely. Architecture had replaced instinct. The managing authority remained respected. Reputation intact. Legacy undisturbed. But legacy no longer dictated flow. Flow responded to system design. The silent participants' capital continued compounding within disciplined parameters. Returns were steady, unspectacular, durable. Durability creates permanence. Other partners increasingly adopted similar posture, measured speech, data-first positioning, reduced rhetorical persuasion. Meetings shortened. Debates cooled. The firm felt quieter, not subdued, stabilized. Silence no longer signaled anticipation of dominance. It signaled mutual confidence in structure. Confidence rooted in structure does not depend on personalities. One final development solidified the shift. A long-standing external advisor, known for strong influence over the managing authority, recommended a bold thematic expansion during a quarterly strategy session. The proposal carried persuasive energy and compelling narrative framing. The room listened attentively. The silent participant requested structured modeling across stress bands before consideration. Others echoed the request, not as defiance, but as standard protocol. The advisor complied. When results returned, exposure risk exceeded tolerance corridors. The proposal was declined without tension. The managing authority nodded in agreement. No persuasion attempted. In earlier years, such a recommendation might have advanced on conviction alone. Now it required structural alignment. Structure prevailed. The silent investor had never sought visibility, never challenged authority publicly, never demanded reallocation of formal power. Capital had moved patiently. Discipline had remained consistent. Silence had absorbed volatility without theatrics. Over time, silence became gravitational. The firm continued thriving. Returns stabilized. Reputation strengthened. External observers attributed success to seasoned leadership and evolving governance. Internally, however, influence no longer radiated from a single voice. It flowed through disciplined architecture shaped quietly over cycles of restraint. The irreversible shift was complete not because control was seized, but because dependence dissolved. The silent investor remained seated where they had always sat, unchanged in posture, unchanged in title, but structurally central. And once centrality embeds itself within system design rather than personality, it does not revert. The managing authority retained position with composed dignity, yet direction no longer originated there. It emerged from distributed discipline. Silence settled into permanence, and permanence does not announce itself. It endures.